Welcome to Thoughts on the Market. I'm Ariana Salvatore, Morgan Stanley's U.S. public policy strategist. Today, I'll talk about a development keeping markets and investors on alert, a re-escalation of U.S.-China trade tensions. It's Friday, October 17th at 10 a.m. in New York. Since April, the U.S. and China have been in what we've been calling a very delicate détente. Remember, President Trump paused the additional reciprocal tariffs after Liberation Day. Since then, we've been consistently skeptical that the pause was durable enough to actually allow the U.S. and China to come up with a full-fledged trade agreement. But now we're equally as skeptical that the current escalation will lead to a material disruption in the bilateral relationship. So what happened last week? China announced stricter export controls on rare earths, which are really critical for manufacturing everything from electric vehicles to defense equipment and advanced electronics. So in response, the Trump administration on Friday announced a proposed 100% tariff set to go into effect November 1st across all Chinese exports to the U.S. That date matters because that's around the same time that Presidents Trump and Xi were scheduled to meet at the upcoming APEC summit in South Korea. When we think about this most recent escalation, it's pretty significant because China accounts for about 70% of global rare earth mining and 90% of processing and refining. A lot of countries around the world, the US, Japan, Korea, and Germany, all rely heavily on these imports from China. And so potential new export controls mean that every economy may have to start negotiating bilaterally with China to secure supplies, which raises the risk of supply chain disruption across Asia, Europe, and the US. Looking ahead, we're thinking about 4 potential scenarios for how the current US-China trade tensions could play out. The most likely outcome, which is our base case, is a return to the recent status quo, following a period of rhetorical escalation and likely a reset of expectations heading into this APEC meeting. That's because we think both the US and China would prefer to maintain the existing equilibrium to an abrupt supply chain decoupling. That equilibrium is effectively chips for rare earths. So the US receives China's rare earths, and then in return, the US exports some of its chips to China. But that equilibrium doesn't necessarily mean that the temporary implementation of trade barriers, like higher tariffs or more export controls, are off the table. The broader trajectory, we think, will continue to point toward competitive confrontation, which is a bipartisan strategy that encompasses both these traditional trade tactics as well as unilateral domestic investment, either vis-a-vis direct federal spending or the government taking more stakes in companies involved in these critical industries. So think things like the IRA, the CHIPS Act, and other bipartisan pieces of legislation. So in the near and medium term, expect to see these trade barriers persisting and a bipartisan push toward U.S. industrial policy as the U.S. attempts to undergo selective de-risking from China. Our base case scenario anticipates further short-term tensions, but ultimately a limited agreement that avoids deep structural changes. We've also thought through some alternate scenarios. So in one downside case, you could see temporary escalation past November 1st. Both sides could fully implement their proposed policies, but after doing so, come back to the status quo once the economic costs become apparent. A more severe downside scenario involves durable escalation. So in this case, we would see both countries maintain trade barriers for an extended period. That outcome would see both the US and China decide to change calculus on that equilibrium. So that no longer holds. And in that case, we could see a push toward decoupling and a significant strain on supply chains. Finally, our last scenario reflects a quick de-escalation, in which heightened rhetoric actually acts as a catalyst for renewed negotiations and a potential framework agreement. That could result in some tariffs, but most likely at lower levels than initially proposed. So what does this all mean? In the base case, our economists expect China's GDP growth to slow to below 4.5% in the second half of 2025, with exports supported by robust non-U.S. shipments. Our equity strategists in this outcome see the volatility actually providing a dip buying opportunity, given that they see a rolling recovery that began earlier this year. However, a more durable escalation could possibly prolong China's deflation and necessitate further policy adjustments. Similarly, that outcome could negate the early cycle rolling recovery thesis here in the U.S. Thanks for listening. If you enjoyed the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.